Our Japan business is becoming more and more mobile. People love to trade on their phones there. They're, as you're probably aware, they're purchasing groceries on their phones and everything else now. So they're already a very mobile mindset. It's easily adaptable to trading. So we're seeing a lot of it. It's growing globally. There's no region really where it's not growing. Some, I would say more than others, but there's not a region where it's shrinking or idle. No. It's growing all over.
And talk is that in 5 years, laptops and desktops will be obsolete, which is an incredible thought. Isn't it? So I
wouldn't mind that day, actually.
So when you know you're going to go to a conference, you don't pack
anything.
You don't pack anything. You just take your handheld. And so you agree that's probably.
I do. I don't think it'll be 5 years, but I think 10, 15. It wouldn't surprise me if everyone's on mobile and almost only mobile.
And I know something else that you're at the forefront of is the no dealing desk trading. If you could give us a bit of background of that as
Absolutely.
How you see that also.
We were largely the inventors of it, especially when you're speaking specifically to our industry, retail FX. FXCM operates on a no dealing desk basis, meaning all of our client trades are passed through one for one at the time that our client places the trade, and offsetting trade immediately goes to our counterparties, basically. That puts us in the very noble position of never holding position against our clients. So we don't profit off our client losses, we don't lose off our client profits, basically. We make a very small transaction markup every time a client places the trade, and that's it. So we're in the noble position of actually hoping our clients make money, all of them, on every single trade. Because if that's the case, they'll trade more, and hopefully they're out telling their family and friends that they're making a killing in FX, and they're doing it at FXCM. So we're very much on our client's team in that sense. So we provide education, we provide a great deal of research, and we provide a state-of-the-art charting package, and again, the automation, the backtesting functionalities, all of that, because we want our clients to be profitable, we want our clients to have a very positive experience, because we're not making money off their losses. Our competitors are on the opposite side of that coin, where they actually do speculate against their own clients, and they make profits when their clients lose and all of that. I think the no dealing desk trend will continue to grow. We're certainly not, while we were the originators, I would say, we're certainly not the only firm to offer it anymore, and I see more and more of the dealing desk firms also offering a no dealing desk option, so clients can choose between the two. And I think that will continue. I think some regulatory regions will actually mandate no dealing desk, so they take out that conflict of interest that's inherent in dealing desk models. I think it's just a matter of time before more and more, if not the whole industry, migrates to a no dealing desk setup.
I see even on your website, or maybe it's a comment by yourself at some stage, but this helps sort of offset the Wild West, I think.
Absolutely.
The Wild West perception
of FX. Yep.
Because it does have that sort of it's totally misplaced, of course, but the unregulated free-for-all market, which
FX is still unregulated in quite a bit of the globe. Obviously, in the more advanced financial jurisdictions, certainly in the United States, certainly here in England and Western Europe, Australia, Japan, Hong Kong, all have heavy regulation. And to give credit, the regulators know this market very, very well, specifically here in the UK. The FSA has been around FX. They've been around CFD trading for a long, long time now. So they know this space. They know exactly how to protect the clients and how to regulate the firms involved. There are still a lot of regions that aren't regulated. Now, we as a firm send all the business from those regions through our regulated entities, either here in the UK or in Australia or in Hong Kong or in the United States or what have you. But yeah, regulation continues to evolve and develop, and some of the ones that are newer to it are making their own efforts to squash the Wild West reputation of the space. And I think the first thing that they can do that we all benefit from is squeezing out the bucket shops, the guys that are just fly by night, spend a great deal on marketing, convince people that they can make millions of dollars overnight, make the money off of those client losses, and then just churn the client base. So when a client loses, they just got to replace him with a new guy, and they do that by spending the $100 or the $100,000 they just made off that losing client on marketing to bring in 5 more clients, basically. And that's bad for everyone. Certainly bad for the client, bad for reputable firms like FXCM, bad for the regulator, bad for the space, bad for everyone except that bucket shop firm. And even long term, it's bad for them.
And transparency, sites like ours, even the more that we can shine the spotlight on this as an industry.
Yeah, absolutely.
We can only help.
Absolutely.
As a demarcation between retail and institutional trading narrows, with traders becoming increasingly wised up,
Yeah.
will the classic spread betting offering be enough for the everyday trader to get their teeth into, do you think?
I'd say yes, in the sense of the structure is fine. There's no, in the demarcation between institutional and retail FX, it's not like institutional clients are trading any different instrument or anything along those lines. The trend and the demand is that retail clients are demanding wholesale prices, what institutionals would pay. So that's a trend that has been expected. That's a trend that every other industry, especially in the brokerage space, has gone through, and we're not unique. You know, we need to cater to the moving demands and shifting expectations, and we do that. So you'll see spreads, and you already have, come in more and more, even for the retail client, to match, you know, pretty closely what institutional spreads are, and that's good. It provides more transparency, better execution, lower cost per transaction to retail users, which is fantastic. And
another contentious issue, or the contentious issue at the moment, with the carry trade having been such an integral and sort of crucial part of the business, and now people are saying, is there any carry in the carry trade? Is the carry trade dead?
I think it's dead for a while. I don't think it's coming back this year, and I would say probably not next year either. There's a lot of uncertainty in the market. Obviously what's going on in the Eurozone and Greece and Spain and Italy, people aren't jumping into the carry trade. They're just the opposite, instead looking for safe haven currencies, and those are the low yielding currencies. That's the US dollar, the Swiss franc. People are buying those, not selling those. So I think the carry trade is off for a bit now. It doesn't mean there's no trading opportunities by any means. In fact, just the contrary. Because of the speculation and the uncertainty about Europe, there's a great deal of volatility and a great deal of, I would say, trading opportunities out there. I just wouldn't list a long-term carry trade as one of those right now.
No.
You're not going to collect a lot of yield, and the danger is that Greece defaults, whatever. Spain, follows suit. Italy follows suit. The euro collapses. Again, more and more people are piling into safe haven currencies, and that will squash whatever rolls you're earning on your carry trade. So I don't think it's going to be around for this year and probably next time.
The bank sitting on interest rates as well doesn't help.
Right.
You've touched then on what's happening in the Eurozone and the macroeconomic aspects. You as a qualified chartered financial analyst, having that background must be a boon at the moment.
It's good. I passed the CFA exams 3 or 4 years ago now, and it's good because it helps develop the analytical mindset. I would say the content, the curriculum of the CFA is more micro-based. It's more analyzing business financial statements and things like that, which helps from an executive standpoint and being a businessman. Probably doesn't help a great deal when analyzing macroeconomics and markets and geopolitical situations like what's going on in the Eurozone right now. I think the fate of the euro, and if people are looking for trading opportunities, really just read the headlines. What comes out of Greece, what comes out of Italy, what comes out of the UK, interest rate decisions like that. The big headlines are going to be what determines where the euro goes from here, not necessarily charts, support and resistance levels, MACDs and things like that are good for the short term, but the medium and long term, these are geopolitical movers that are going to determine the fate. The CFA was well worth it. I'm glad I did it. Believe it or not, the FX sections of the CFA exams were probably the ones I did the worst on, only because in the curriculum they quote the currencies inverse to how they're quoted in real life. So when you're trying to get through 100 questions in an hour, you go quick. And I never made the translation, so I would do it the way I'm used to it and the way they're actually done in the market. And for whatever reason, got a lot of those wrong.
We'll keep
embarrassingly so. Yeah.
Okay, so with social trading now is the next big thing.
Yeah.
Especially mirror trading and following professional gurus.